1.02 USD. That is the number flashing on the screen right now. We are looking at a gain of roughly 0.16 cents, which translates to a massive intraday surge of 19.01% as of this very moment. If you are watching the ticker tape, you are seeing a stock that was left for dead just days ago, suddenly waking up with violent volatility. The market opened today with low expectations, assuming the recent downward spiral would continue. But the reality is playing out very differently in the short term. We are witnessing what looks like a classic technical reaction, a volatility squeeze occurring in the aftermath of one of the most brutal capitulation phases this company has ever seen. While the general consensus is that Beyond Meat is spiraling toward irrelevance, the price action today forces us to pause and look at the mechanics under the hood. When a stock trading near $1 jumps nearly 20% in a single session without a headline-shattering positive catalyst, it signals that the market's bearish positioning has become too crowded. And the reality is that sellers are exhausted, forcing a snapback rally that could trap late shorts. You might be sitting there thinking this is the start of a recovery, or perhaps you are wondering if this is the final gasp of a dying brand. That is the tension we need to explore. The expectation is that a company trading at penny stock levels, down over 97% from its all-time highs, has no fight left. The reality, however, is that these zombie zones are often where the most aggressive, high-risk trading occurs. We are not talking about fundamental value investing here. We are talking about market structure, liquidity gaps, and the psychology of a distressed asset. To understand why Beyond Meat is up 19% today, we have to look beyond the burger and look at the balance sheet engineering that took place just last month. Let's talk about what is actually driving this movement right now. You have to look at the volume. It is surging well past its average daily turnover. When you see volume spikes of this magnitude on a stock priced at $1.02, it often indicates high-frequency trading algorithms and retail speculators entering the fray, likely using platforms like Robinhood or SoFi Invest to chase the momentum. This isn't necessarily Fidelity Mutual Funds or Vanguard ETFs loading up for a 10-year hold. This is fast money. This is the greater fool theory playing out in real time. The expectation is that smart money is buying the dip. The reality is that day traders are playing a game of hot potato before the weekend. Consider the context of the last few weeks. October 2025 was a bloodbath for this stock. The company executed a massive debt for equity exchange, essentially printing new shares to pay off bondholders. We will discuss that in detail later, but the hangover from that dilution is what set the stage for today's action. The stock was pushed down so violently that it entered oversold territory on almost every technical metric available. When a stock falls that hard, it behaves like a beach ball held underwater. Eventually, the pressure releases and it pops up. That is what we are seeing today. It is not necessarily a vote of confidence in the future of plant-based sausage. It is a mathematical reaction to extreme selling pressure. If you are an active trader using Interactive Brokers or checking the charts on your Schwab Intelligent Portfolios dashboard, you know that volatility is an asset class of its own. Beyond Meat has effectively morphed from a consumer staples growth story into a high beta volatility instrument. It is trading less like a food company and more like a crypto token or distressed tech play. The correlation here isn't with Tyson Foods or Kraft Heinz anymore. The trading behavior resembles the wild swings we used to see in the early days of Tesla stock or during the peak of the meme stock mania. The difference, of course, is that Tesla had a path to profitability and dominant market share. Beyond Meat is fighting for survival. Let's challenge the common narrative that plant-based is the future, and therefore this stock must eventually recover. That was the thesis in 2019. The reality in late 2025 is that the macroeconomic environment has shifted entirely. We are dealing with persistent food inflation. When the average family goes to the grocery store, they are voting with their wallets. The premium for plant-based alternatives has become a hurdle that ideological marketing cannot overcome. The expectation was that economies of scale would make fake meat cheaper than real meat. The reality is that processing costs, ingredient sourcing, and supply chain complexities have kept prices high, while the novelty factor has worn off. This brings us to the recent earnings and the specific financial health of the company. We just wrapped up the third quarter of 2025, and the numbers tell a stark story. Revenue is down year over year. The U.S. retail channel, once the crown jewel of their growth strategy, is shrinking. This is critical. If people are not buying the product at Kroger or Walmart, the business model breaks. The expectation was that partnerships with fast food giants would save them. Remember the McPlant? The hype was palpable, but reality hit hard when trial runs didn't convert into permanent high-volume menu fixtures across the board. Fast food consumers want cheap and familiar. Beyond Meat struggled to be either. But the biggest elephant in the room, and the primary driver of the stock's collapse to these $1 levels, is the dilution event from October. Let's break this down because it's complex but essential. Beyond Meat had over $1 billion in convertible debt. In simple terms, they owed a lot of money that they didn't have the cash to pay back when it would eventually mature. To avoid a default scenario, they launched an exchange offer. They asked bondholders to trade their debt for a mix of new, later-dated bonds and, here's the kicker, equity. A lot of equity. When a company issues millions of new shares to pay off debt, it slices the pie into much smaller pieces for existing shareholders. This is called dilution. In October 2025, the news of this swap triggered a 50+% drop in the stock price in a single day. The float, the number of shares available for trading, exploded. If you held Beyond Meat stock in your Fidelity brokerage account before that swap, the value of your ownership percentage plummeted overnight. The market expectation was that this restructuring would save the company by extending its runway. The reality was that it decimated shareholder value to keep the lights on. It was a desperate maneuver, a financial tourniquet applied to a bleeding limb. Now fast forward to today, November 28, 2025. The stock is at $1.02. Why? Because the market has digested that dilution. The new shares are in circulation. The bondholders who received stock might have sold it, driving the price down to that sub-$1 low we saw recently. Now that the selling pressure from those bondholders has potentially eased, the stock is finding a temporary floor. This bounce to $1.02 is the market saying, okay, the worst of the dilution news is priced in. What's left? What is left is a company that is still burning cash, albeit at a slower rate due to aggressive cost cutting. They have shut down production lines, reduced headcount, and pulled back on marketing. This is the classic shrink-to-grow strategy, but so far it has been mostly shrink. The expectation is that these cuts will lead to positive cash flow. The reality is that you can't cut your way to growth if revenue keeps falling. You need people to buy the burgers. And then there's the legal battle. Just days ago, news broke regarding a trademark infringement verdict against Beyond Meat, resulting in damages of nearly $39 million. For a company like Apple or Microsoft, $39 million is a rounding error. For Beyond Meat, in its current fragile state, that is a significant hit to liquidity. One would expect the stock to crash further on this news. Yet here we are, up 19% today. Why? This is the contrarian take I mentioned earlier. Sometimes when a stock is beaten down so thoroughly, even bad news can't push it lower because there are no sellers left. Everyone who wanted to sell on bad news has already left the building. The market might be looking at the $39 million judgment and thinking, we can appeal this, it will take years to pay, it doesn't bankrupt them today. The market focuses on immediate liquidity, and the debt swap, as painful as it was, solved the immediate liquidity crisis. I want you to take a moment and think about your own portfolio. It's easy to get caught up in the excitement of a 19% green candle. It triggers that dopamine hit. You might be tempted to open your Robinhood app or log into SoFi Active Investing and throw some capital at this thinking it's the bottom. But you have to ask yourself, are you investing or are you gambling? There's a difference. Investing is about future cash flows. Gambling is about price action. Beyond Meat right now is a trader's playground, not an investor's haven. Speaking of holding, I want to hear from you. Comment below how many shares of Beyond Meat you currently hold and what your average cost basis is.